You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Coming up on today's program, is it time to sell? Also coming up, habits of the investing greats. Yes, if you want to have legendary results, well then, you need to start behaving like a legend. I'll tell you about one habit of the investing greats that we all need to work on. Also, a mini study comparing the stock market correction from early 2016 to the one happening right now. We'll talk about the similarities and the differences. 844-305-7800 is the number if you'd like to join us. Give us your first name along with your city and your ticker symbols. Also, if you'd like to tweet the program live, @Index Show is my Twitter handle. Be sure to, again, when you tweet us, give us any ticker symbols, stocks, mutual funds, ETFs that you want me to discuss and cover. We can do that. Again, 844-305-7800 is the number. So let's begin by taking a look at what happened this past week in the stock market. Of course, it was not a good week by any measure. We saw the S&P 500 dropping almost 5% on the week, and the slide came as investors are already looking ahead to next year, continuing to question the strength of the broader economy and also very worried about the potential impact of trade issues between China and the U.S. As I said in the December issue of ETF Guide Premium, which was released about a month ago, I asked the question, has the foundation for the next economic recession, has it already been laid? Because when I look at it, what I see is a Trump White House that's probably overplayed its hand and already inflicted lots of damage to the U.S. economy. We're already seeing that in key industry sectors like industrials, ticker symbol XLI, energy, ticker symbol XLE, materials, XLB, which are all down significantly compared to the broader stock market, and they're probably not done sinking just yet. And just wait until fourth quarter earnings get released in the first quarter of 2019. I think you're going to see the rot begin to surface. Investors are going to really get a firsthand look at just how much damage has already been done to corporate earnings. So even if there is a deal between China and the U.S., and I think there will be, you've got to wonder, will it be too late? Will the damage already have been inflicted? And will the momentum that we're seeing in this stock market correction to the downside continue because of that? So these are all things that I see. I'm observing. The stock market, of course, lest I remind you, is a leading indicator. It's a leading indicator. Forget about all these other indicators like unemployment and employment and wage growth and all these other things. These are all indicators of secondary and tertiary importance. The primary importance is the stock market. That tells you what exactly is the mood and sentiment of the masses as reflected through the price of stocks. So right now the sentiment is very scared. Volatility and fear are up. Stock prices are down. And so for that reason, I think it's a good thing for us to do on today's program, a mini study. I want to compare the 2016 correction, which was pretty fast and furious. It happened very quickly. But I want to take a look at that and compare it to the current market correction that we're in. And we're going to use it as a point of reference in trying to understand where stocks are at right now and what it may portend yet ahead. So stay tuned for that. We're going to do that exercise together. Also, I wanted to declare the winner of last week's trivia question. We did not get any calls or tweets, but we did get an email from Jerome in Reno, Nevada, who answered the trivia question correctly. And in case you forgot, if you didn't listen to last week's episode, the question was, in what year was the first U.S. ETF introduced? Well, the correct answer was 1993. It was the SPDR S&P 500 ETF, ticker symbol SPY. That was the very first U.S. ETF introduced, and Jerome got that question correctly. He won a signed copy of my book, Gents with No Sense, a closer look at Wall Street, its customers, and the media. So good job, Jerome. Now, for today's trivia question, because I'm going to have another signed copy of that book, Gents with No Sense, available for the winner. Here is the question. Collectible items sometimes become manias. So in the 1990s, there was a particular childish version of this cycle with a short-lived popularity of this particular toy. Was it A, Beanie Babies, B, Tickle Me Elmo, C, Pogs, or D, Pokemon cards? What was the mania that defined the 1990s? A childhood version of that. Was it A, Beanie Babies, B, Tickle Me Elmo, C, Pogs, or D, Pokemon cards? If you know the answer to that trivia question, 844-305-7800 is the number. At Index Show is my Twitter handle. You can also email the show with your answer, ron@indexshow.com. The winner will get a signed copy of my book, Gents with No Sense, a closer look at Wall Street, its customers, and the media. Taking a look at market performance, we want to look at this on a year-to-date basis. That means since the start of 2018. And let's take a look at this from the angle of all the major asset classes. So what I'm talking about is stocks, bonds, commodities, and real estate. So let's begin with the first area, U.S. stocks, ticker symbol VTI, which as a group are down almost 0.5%. So even though we've had a vicious sell-off really since the start of October, the broader U.S. stock market is still only down not even 0.5%. So that performance is actually doing better still than the total U.S. bond market, ticker symbol BND, which is down just a nudge over 1%. Also, international and emerging market stocks continue to be in a funk and underperformers. VEA and VWO, which track those two areas, down between 12.5% to 14% since the start of 2018. Two more major asset classes, commodities as a group, ticker symbol USCI, down almost 8.5%. And then global real estate, ticker symbol REET, ahead by 1.7%. That is the leading major asset class throughout the globe. Yep, it's global real estate, which again is ahead as a group by 1.7%. Those figures, by the way, through the market close of December 7th. 844-305-7800 is the number. At Index Show is my Twitter handle. If you're just joining us, you're listening to the Index Investing Show. We're here every week at this same hour. How has your portfolio held up since this stock market correction began in October? Usually we begin to discover flaws in our investment strategy, in our investment plan, or in our investment portfolio, usually when the market starts to go down. Then all of a sudden the flaws begin to get exposed. And so this is one of the reasons I encourage you, if you haven't done so, to go to portfolioreportcard.com and see how you're doing. I'll tell you whether your investment portfolio, your retirement portfolio passes or fails. And that's something I make available to all of our listeners. If you get an A, I will even pay you $100. So check that out at portfolioreportcard.com. So coming up on today's show, we're going to get into our mini study of 2016, the market correction that happened then, and the one that's happening right now. We're also going to talk about habits of the investing greats. What do they do differently versus the rest, versus the masses? That coming up right here on the Index Investing Show. I'm Ron DeLegge. I'll be right back. Go nowhere.
The Index Investing Show with Ron DeLegge.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
It was the billionaire and investor and trader Paul Tudor Jones who famously said to do the trade that makes you puke. And in the December issue of ETF Guide Premium, which is available at etfguide.com, I've got a chart of a trade that made us puke and profit simultaneously. Can you imagine that? Puking and profiting in the same sentence. And in that issue is a chart of ticker symbol VIXY, which attempts to track short-term VIX futures contracts. And that particular trade was a big-time winner, ended with a double-digit gain. And so that just shows you that there are opportunities out there when stocks decline in price, as they're doing right now. And according to CNN, they have a very useful tool. It's an indicator called their Fear and Greed Index. And the question they're trying to answer is what emotion is driving the stock market right now? And the stock market is counterintuitive. So what that means is that when people are the most fearful, when people feel the most danger, usually is the best time to invest. Conversely, when people are jubilant, that's usually the worst time to invest. So it's a counterintuitive exercise, and usually what happens is that you find and make the best investments when sentiment is the worst. Now, what is the Fear and Greed Index saying right now? Currently, the CNN Fear and Greed Index is reading at extreme levels. Out of 0 to 100, with 0 representing the most fear and 100 representing the least fear, right now we're at 11. So remember, 0 is the most fear, we're at 11. 100 is no fear, and right now we're at 11 again. So that just helps you understand that the sentiment, the market's mood, is very jumpy, very scared. And of course, volatility is shot higher. And taking a look at the performance of a couple of industry sectors that have benefited from the weakness, some areas that have been strong have been defensive sectors like utilities, ticker symbol XLU, which are ahead almost 10% since the beginning of the year. So utilities continue to be a pocket of strength. Also, real estate, also known as REITs, ticker symbol XLRE, are ahead by 6.5% since the start of the year. And quite interesting, the performance there from REITs and commodities, especially when we've had interest rates rising, which generally is not good for these rate-sensitive sectors. Yet, it seems like a lot of money is pouring into these sectors because of the fact they're viewed as a defensive haven when the broader market is experiencing a sell-off as it is right now. One other area that's done well is healthcare stocks. XLV ahead by almost 11%. So those particular areas within the S&P 500 continue to be standout performance. Weakness across the board in financial stocks, energy stocks, and materials. Those three sectors down between 9 to 13% and continuing to struggle thus far in 2018. 844-305-7800 is the number. You're listening to the Index Investing Show. We're here if you'd like to join us to talk about anything financial on your mind. You want to talk about the stock market correction that we're currently in. You want to talk about a specific industry sector, a specific mutual fund, ETF, or stock, we can do that. At Index Show is my Twitter handle. You can follow me there. Speaking of Twitter, oh my gosh, I've got a lot to say on Twitter. I got into kind of a frenzy of just some things that were on my mind that were triggered by the latest stock market correction. I'd like to share that with you right now. First, the one-dimensional buy and hold strategy or buy and never sell strategy is cute when stock prices are rising. But when stocks fall and you're withdrawing 3 to 6% of your portfolio for retirement income, the risk of running out of money substantially jumps. That's on my Twitter feed. Also, I followed that up with this. People at or nearing retirement should have an adequate margin of safety. That is principal protection carved out from their investments And of course, that should concur with a person's risk capacity. Here's something else on Twitter. Telling the investing public to keep holding their index funds and suffer potential drawdowns of 20% or more is A, irresponsible, B, negligent, and C, not risk management of any kind. Also, prudent investors and prudent advisors teach the public how to build investments on the right foundation, how to grow the portfolio of investments, and finally, to protect it. And I have protect in capitals. It's a multidimensional process versus the one-trick approach of investing without an adequate cushion. People need to be helped before a significant drop, not after. And that's another element of prudent investing. It's having an adequate cushion before a market crash, before a bear market, not after. Think of it as insurance. The time to acquire insurance is not after the house burns down. You have to have some foresight. You have to have some discernment. You acquire insurance before the house burns down. And in a similar way, people should be building their portfolio's margin of safety, their principal protection, right now, before this market correction deepens and becomes something else. So that's a message that I've regularly preached on this show. It's my investment philosophy. I know it works. I know that it keeps people sleeping sound at night, and it also keeps the risk parameters of your portfolio in line with your own risk tolerance or capacity. I want to get to an email from a longtime listener. Dear Ron, I'm trying to get low-cost exposure to commodities. What do you think about the Aberdeen Standard Bloomberg Commodities Fund? That's ticker symbol BCD. I'm thinking about making this fund 2 to 5% of my core portfolio. Any thoughts? I noticed assets under management are thin, but I would only invest about $30,000 or less. Signed, Ben. Well, based upon my analysis, Ben, of more than $200 million with my portfolio report card service, the one major asset class that's consistently missing from most portfolios is commodities. Now, even though I know everyone has eggs and coffee in the kitchen, that does not mean that you've got adequate exposure to commodities. And so I'm glad that my message of broad asset class exposure is getting through to the audience. And clearly, if Ben's asking me about it, that message is getting through. So let's take a look at ticker symbol BCD, because that's the ETF in question. It is an actively managed commodities ETF, meaning it's trying to outperform commodity indexes. Now let's think about this together, Ben. Let's employ deduction, not seduction, deduction. So for any investments used inside your core portfolio, they should always be accurate proxies of the asset classes where they invest. And in all cases, including this one, actively managed funds of any kind are never accurate or acceptable proxies of the asset classes where they invest. Why? Because their chief concern is not to replicate the performance of the asset, but rather they're trying to deliver outperformance. And they try to do that in all different ways. They concentrate their exposure, they use leverage, other strategies that, again, undermine their ability to serve as a broad proxy for the asset class where they invest. So I would look at a couple of other choices, ticker symbol USCI or DBC, and I want to get a little bit more into why those may be better choices than BCD when we come back. This is the Index Investing Show. I'm Ron DeLegge. Stay with us. More just ahead.
The Index Investing Show with Ron DeLegge.
The investment world is full of complex and expensive products. At Sector Spiders, we recognize the need for lower costs, more clarity, and greater focus. So we wrote a new chapter for today's investors. Sector Spider ETFs divide the S&P 500 into 10 distinct sectors. You can see exactly what you're investing in, with full transparency. Each sector has the diversification of a mutual fund, the flexibility to tailor your investment strategy, the all-day tradability of a stock, and the tracking of an index. Sector Spider ETFs can be used to customize your portfolio allocations, overweight or underweight your sector exposure, and minimize single stock risk. Now it's time to turn the page to a clearer, more focused approach. Sector Spider ETFs, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
844-305-7800 is the number. This is the Index Investing Show. At Index Show is my Twitter handle if you'd like to follow us or tweet us. As I said on my Twitter feed from this past week, protecting your investment savings is not an accidental process. That's something that I know is a fact. You don't accidentally protect your money. It's a very deliberate process. It's part of having a architecturally sound investment plan and investment strategy, which leads to sound investment portfolio. So check us out at Index Show on Twitter. Tweet the program, follow the conversation. Also, by way of reminder, if you ever miss our regular radio broadcast, you can pick up our podcast. It's available at indexshow.com. You can also find us at YouTube, Google Play, and Apple iTunes. Just search under the Index Investing Show. Now, we have some trivia for today's program. The trivia question is this: collectible items sometimes become manias. During the 1990s, this particular toy, childhood toy or childish toy, had a short-lived but high level of popularity. Was it A, Beanie Babies, B, Tickle Me Elmo, C, Pogs, or D, Pokemon cards? If you know the answer to that question, you can call the program 844-305-7800. You can tweet it at Index Show or email me, ron@indexshow.com. We told you earlier about some of the key performance of broad stock market indexes, bond indexes, commodities, real estate. We told you that real estate right now is the single area that's outperforming all major asset classes. Global real estate ahead by almost 2% since the start of 2018. Those defensive industry sectors like utilities and REITs doing quite well, up to the tune of 6.5% to 10% since the start of the year. So those areas are excelling. Healthcare stocks are also holding up very nicely and delivering double-digit returns. Can you imagine that? Even with the total U.S. stock market down almost 0.5%, healthcare stocks, pharmaceuticals, still holding on to double-digit gains, up almost 11% since the start of 2018. So that sector continues to excel. Now, we were talking earlier about commodities. We had a question from Ben about which ETF to use to get core exposure to commodities. And he was looking at the Aberdeen Standard Bloomberg Commodities Fund. That's ticker symbol BCD. And the point that I was trying to make to Ben was that BCD has several major problems with it. Strike one is it's not an accurate proxy of commodities because it's an actively managed fund versus being index-based. That means it's trying to outperform the group versus trying to match the exposure of the group. And strike two is that it has anemic assets and it's thinly traded. Strike three is BCD is inferior compared to other commodity ETF choices. And the reason I know it's inferior is just taking a look at its performance. It hasn't been on the market very long. It was launched in 2017 during the spring, so it hasn't had much of a long trading history. But if we go back to its inception, instead of beating or outperforming its index peers as it was designed to do, BCD has actually performed about the same. And that's not something that you look for in an actively managed fund. You want outperformance. But more importantly, and I think this is where we really got to focus on, for a core portfolio, again, the chief concern is not we're looking for outperformance. We're trying to outperform other funds or outperform the index. What you're looking for in a core portfolio, the number one chief concern is not outperformance, but rather you're looking for funds or ETFs that are accurate proxies of the asset classes that they are investing in or that they're tracking. That's what you want. And so in this case, you have much better choices. Take a look at ticker symbol USCI, that's United States Commodities Fund, or ticker symbol DBC, which is another fund. That one's called the Invesco DB Commodity Index Tracking Fund. And I think both of those funds are good ones to look at for a core commodities exposure. And they both have decent sized assets under management. And they both have expense ratios between about 90 basis points to a little over 1%. So that's a little bit higher than most of the equity and bond ETFs out there, but this is commodities. It's a completely different ball game. It's a completely different asset class. And in terms of getting affordable exposure, that is your best choice, Ben, USCI or DBC. If you'd like to send me a question, a comment about anything on your mind, a specific investment strategy, ticker symbol, retirement question, you can send me that to @IndexShow. That's my Twitter handle. Or you can even email me, ron@indexshow.com. Be sure to put your first name along with your city. Also wanted to mention that the winner of today's trivia question will get a signed copy of my book, Gents with No Sense, A Closer Look at Wall Street, its customers, financial regulators, and the media. And if you have not had or seen Gents with No Sense, it's a classic. It's a book I wrote several years ago. And if you check out the reviews at Amazon.com, just look under Gents with No Sense. You'll see all the wonderful comments that I've had over the years. And it's just one of those books. I wrote it as kind of a timeless send-up of Wall Street and just sort of the nonsense and silliness that we see on such a regular basis, not just from the street itself, but from the regulators, from the customers, and especially from the media. So check that out, Gents with No Sense at Amazon.com. Is it time to sell? That's something we're going to talk about later on the show, coming up in the final segment. Is it time to bail on whatever, stocks or other investments that you may have? Usually when something is going down in price, when it's falling, when it's cratering or collapsing, usually this is the time that people begin to ask the question, is it time to just bail and sell out and go to cash? So I want to share with you something that Philip Fisher, an investing legend, had to say. That's coming up a little bit later, so stay tuned for that. Now, speaking of legends, I whet your appetite earlier by telling you about habits of the investing greats. What makes them stand out isn't just about the types of investments that they make. It's not just about the stocks or other assets that they buy. It's also about their habits. And the habit I want to point out on today's show is that of being humble. The opposite of being humble is being proud, being overconfident, being cocky. These are the sort of undesirable traits that lead to trouble, not just in daily life, but with a person's financial life. People are often the most overconfident after they've enjoyed a winning streak. Now, Gerald Loeb once observed that it's wise to remember that too much success in the stock market is in itself an excellent warning. And I want to share with you an example of supreme overconfidence that was exercised and shown by a certain company. And I'm going to share that with you in the next segment. And it will help us to understand why this is a habit that the investing legends cultivate, humility versus overconfidence, and why overconfidence can be so dangerous. So that's going to come up next. We're also going to talk about, is it time to sell? I'll give you a couple of pointers on that. This is the Index Investing Show. I'm Ron DeLegge. I'll be right back after this short break.
The Index Investing Show with Ron DeLegge.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
So one of the outstanding qualities or habits of the investing greats is humility, being humble. Now, the opposite of that is being proud or overconfident. Now, the most prominent examples that I can think of exaggerated self-confidence was the acquisition of Time Warner by American Online, also known as AOL, for $165 billion back in 2001. At the time, it was the biggest corporate marriage ever. No doubt AOL's sizzling stock performance contributed to the cockiness of Steve Case and other top executives. From 1992 to the end of 1999, AOL's stock price skyrocketed almost 71,000%. The Los Angeles Times even declared it to be one of the hottest stocks of the 1990s. Ahead of the biggest corporate marriage ever, the combined value of Time Warner and AOL was almost $300 billion. But just 1 year later, the value of that collapsed by almost 57% to $126 billion. The mega merger deal turned out so badly, the name AOL was eventually dropped in 2003 to hide the embarrassment. So what's the lesson? Well, there's two types of individuals: those who are humble and those who are gonna be humbled. Which are you? So the application for all of us is, don't let a streak of success inflate your ego. Be grateful for whatever gains the market gives you, humbly receiving them versus greedily expecting them. And that is one habit of the investing greats: humility. I also want to tell you right now about something I talked about earlier, or alluded to, is a mini study comparing the 2016 correction in stocks to the current one. I want to use it as a point of reference to try to understand where stocks are at right now and what it may portend just ahead. So taking a look at that ugly period from January 1st, 2016 to February 11th of 2016, we saw the S&P 500 fall almost 10.5%. Total U.S. stock market fell almost 11.5% in just really about a month and a half time. The VIX, which tracks stock market volatility, soared 54% over that same time frame. So that was about a month and a half. Stocks fell again between about 10 and 11% here in the U.S. So let's fast forward to now. How does that compare with what's happened here? Really, let's start with October 1st to now, December 7th. Just take a look at that almost two-month period. We've seen the S&P 500 and the total U.S. stock market fall in unison about 9.5% in value. The VIX is up a lot more compared to 2016. Fear is a lot higher. We've got the VIX up almost 100% over the past almost 2 months. So while the performance is almost the same compared to 2016, there's a lot higher fear in terms of the VIX today versus then. Also, this particular sell-off has lasted a little bit longer than the one in 2016. So it has not yet ended. And I should mention, too, that for those investors that have been using inverse performing ETFs since the start of October, you've had a pretty good run here. SPDN, which aims for 100% daily opposite exposure to the S&P 500, that particular ETF has gained almost 10%. SPXS, which aims for 100% triple daily opposite performance to the S&P 500. What a standout performer. SPXS is the ETF ticker symbol, ahead by almost 29% since the start of October. So that's when you see those leveraged ETFs really excel, is when the trend is sharp, when the trend is strong in a certain direction. In this case, stock prices being down, you're going to see really good performance from these inverse performing leverage ETFs like SPXS. So that's our mini study comparing 2016 versus today, the stock market sell-off. I want to ask the question, though, as we begin to close today's program, is it time to sell? That's something that many investors ask themselves. It's kind of what you might say a perennial dilemma right after you buy anything and have held it and owned it for quite some time. Legendary investor Philip Fisher had this to say: there is another and even more costly reason why an investor should never sell out of an outstanding situation, because of the possibility that an ordinary bear market may be about to occur. If the company is really the right one, the next bull market should see the stock making a new peak, well above those so far attained. So how is the investor to know when to buy it back? Theoretically, it should be after the coming decline. However, this presupposes that the investor will know when the decline will end. I have seen many investors dispose of a holding that was to show stupendous gain in the years ahead because of this fear of a coming bear market. Frequently, the bear market never came and the stock went right up. When a bear market has come, I have not seen one time in 10 when the investor actually got back into the same shares before they had gone up above his selling price. Usually he either waited for them to go far lower than they actually dropped, or when they were way down, fear of something else happening still prevented their reinstatement. So Fisher, like many investing greats, is suggesting that the best time for an investor to sell is almost never under the strict circumstance that the security or stock that they've purchased is the right one. The problem is that most investors need to sell, at least eventually, because you need the money. The other problem is that most investors buy the wrong stuff. So let's examine then a few situations when it might be okay to sell. Number one is if you locate a better investment opportunity for your capital. Now, there are certain situations that arise when the light bulb goes off and the discerning person realizes that his or her money is best spent elsewhere. For instance, cryptocurrencies were great in 2017, but are now stuck in a severe bear market, and for all practical purposes, they are dead money. So instead of watching your money melt in value, the discerning investor may say, listen, it's better for me to allocate my money elsewhere. That's the first sign it may be time to sell. Another sign is if you're selling to increase your portfolio's cushion. All investors and traders should absolutely have an adequate margin of safety or cushion built into their investment portfolio. Now, this is a fundamental step that I teach in my online classes. You can go to indexshow.com and enroll in those classes, but it's a rigorous, disciplined approach to investment management that follows the same spirit of Benjamin Graham's margin of safety idea, but rather not just applied to selecting individual stocks, but to the entire portfolio. So that's the next reason when it's okay to sell, if you're going to increase your portfolio's cushion. Finally, the last reason when it may be okay to sell is if you need the money. It's very easy for multi-billionaires to lecture us about, everybody's time horizon should be forever. The chief flaw with that fanciful theory is that A, most people aren't billionaires, and at some point, whether it's for retirement or another pressing need, will need to access their money. And for that reason, B, all people, billionaires included, die, thereby invalidating the sophomoric and novice idea that investments should be held forever. You don't live forever in this system. therefore your investments can't be held forever because you have a limited time horizon. And so if you need the money, if you're taking money for retirement, clearly there's going to be a need to sell investment, raise capital, and use that money, especially in retirement, for income. So those are the 3 rules for selling your investment. I hope they help you. I've got more on that if you want to read the blog post. It's on my Twitter feed, @IndexShow. That does it for another episode of the Index Investing Show. Be sure to join us again next week. Same time, same station. We'll be here. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producer.